The Federal Reserve has been keeping interest rates at the same level for the last 12 months. This is something that they've only done once before in history, and that was right before the global financial crisis. Ben Bernanke, who was the Federal Reserve chair at the time, said that he regrets not having cut interest rates sooner in the lead up to the global financial crisis. That's because back then the Federal Reserve kept their interest rate above long-term interest rates, or what we can consider the neutral rate of the economy. If short-term rates are above the neutral rate, monetary policy is tight, and so it has a restrictive effect on the economy. And you can see in the lead up to the financial crisis, the Fed kept monetary policy tight and restrictive right up until the very start of the recession in December of 2007. So that was a full year and a half of tight monetary policy. This is something, by the way, that the Fed also did in the late 1920s. They kept the federal funds rate above the neutral rate of the economy between January of 1928 all the way to October of 1929, keeping interest rates at very restrictive levels for an extended period. The Fed has also accepted that, in hindsight, this was a policy mistake and that they should have probably cut interest rates a little bit sooner to avoid the Great Depression. Fast forward to today, we have the short-term interest rate of the Federal Reserve above the neutral rate for the longest period of time since these two historical episodes in financial history. Monetary policy has been restrictive now for close to 2 full years. Now, at first, this was necessary in order to make sure that inflation that was running hot in 2022 and 2023 was going to come down to more reasonable levels. But as I'm going to show you in this video, we have strong evidence today that suggests inflation is very much in the process of stabilizing. And with each day that passes, it's becoming more likely that the Federal Reserve is making a big mistake by keeping their monetary policy this restrictive. Now, yes, at the recent Jackson Hole meeting, Jerome Powell said that they would be beginning interest rate cuts starting in September, but they don't plan to cut interest rates down to non-restrictive territory until April of 2025. That's another 5 months from now, which could turn out to be much too slow. We're already seeing signs that the economy is deteriorating rapidly. The ratio of employed to unemployed has been rising very aggressively throughout 2024, showing that businesses are beginning to lay people off, while hiring has now come down to the lowest level since 2020. Now, the Fed has a dual mandate. They need to pay attention to the economy and labor market and striving for full employment. And as we see from the data, that's clearly heading in the wrong direction. But they also need to look at inflation. So let's take a look at the inflation front for just a second. This is a chart of core inflation in the United States, but we're looking at month-by-month data to understand exactly what's going on. And we can see what core inflation has done throughout 2024. It's moved down substantially and is now hovering at the lowest levels since the pandemic. Month-over-month inflation is currently hovering at around 0.1%. That is much lower levels to the 0.3% inflation rate that we've seen over the last 3 years. In fact, these levels are very much aligned with where inflation was between 2009 and 2020, a period where the Fed considered that inflation was running too low. So both the employment mandate and the inflation mandate point to the fact that the Fed should be cutting interest rates and that they should begin to do so quite quickly. Okay, so if the situation is so worrying, why then is the stock market showing so much strength, hovering at all-time highs today? And does that mean that we should be preparing to go leveraged short in preparation for a large economic downturn? Not so fast. You may not believe it, but the stock market is not a perfect machine. It can be irrational about the future at times. Take a look at the 1920s, for instance. Markets were soaring like they had never before in financial history, heading straight into the most severe economic downturn in financial history. And guess what stocks did when the recession hit? They changed their minds and started to trend in the other direction. If investors had known that the Great Depression was lying ahead, the stock market would have never melted up like this. This chart would have probably looked a lot flatter. And likewise, at the beginning of 2009, right here, the stock market was in complete collapse. But in hindsight, this was just a couple of months before the end of the recession, where the US economy began a spectacular recovery. So again, the stock market thought something was pricing the end of the world in February of 2009, but started doing just the opposite in March of 2009. And that's what I believe is currently happening today. Most investors don't believe that a serious downturn is imminent. In fact, when we zoom in on the most recent price action of the S&P 500, the market recently triggered something called a McClellan breadth thrust. And this is typically bullish development for the market. We had this same signal in May of this year, which made us double down on our bullish bets with our members between May and July. This is the McClellan oscillator, and this is what a breadth thrust looks like. It's when the McClellan oscillator goes from being very oversold to being very overextended in a very short period of time. Now, when that happens, it suggests that the market went from being extremely panicked to being very strong in a very short period. And from a quantitative standpoint, this typically leads to high returns looking forward. When we add the S&P 500 on top of this chart, we see that this breadth thrust triggered in May, and this one triggered in November of 2023, right before a massive rally on US stocks. In fact, when we zoom out just a little bit more, we saw the same signal in October of 2022, and again the same signal in March of 2023. Both were followed by upside on US stocks. Now, any signal is prone to giving false signals, but this is to illustrate that this type of behavior tends to lead to good short-term returns in the stock market. Now, stocks are a little bit overextended here and could see a little bit of consolidation as the market digests these gains. But unless we see another big shock in economic data, it seems that the stock market could remain irrational for at least another few months. We intend on taking our members at Game of Trades step by step through this environment, making sure that we're profiting from it, but also hedging and protecting ourselves against downside when the recession does finally materialize.